Hey everyone, welcome back to FinBot Insights. Today, we're diving into a bold claim that's been making waves online. Money printer confirmed equals stocks go up. The post also throws shade at Benjamin Graham, saying M2 money supply is all that matters for market prices. Let's break this down and see if it holds up. Stick around. The post we're looking at features a chart of the US M2 money supply from around 2010 to 2024. M2 includes cash, checking accounts, and other easily accessible money. The chart shows a sharp rise in M2, especially around 2020, peaking in April 2022 at about $21.8 trillion. The claim here is simple: when the money printer goes BRRR, meaning the Federal Reserve increases the money supply, stocks go up. It even mocks Benjamin Graham, the father of value investing, implying his principles are outdated compared to this M2 theory. Let's start with the basics. M2 is a measure of the money supply that includes cash, checking deposits, savings accounts, and other liquid assets. The money printer idea comes from the belief that when the Federal Reserve increases M2, often through policies like quantitative easing, there's more money floating around. This, in theory, boosts spending, investment, and yes, stock prices. During the COVID-19 pandemic, the Fed pumped trillions into the economy and M2 spiked. Stocks like the S&P 500 also soared during this time, which seems to support the post's claim. But is it really that simple? Let's dig deeper. At first glance, the correlation looks strong. From 2020 to early 2022, M2 grew by over 40%, and the S&P 500 gained around 90% from its March 2020 low to its January 2022 peak. More money in the system can mean more investment in stocks, driving prices up. But correlation isn't causation. Other factors were at play. Record low interest rates made borrowing cheap, tech companies boomed, and government stimulus checks fueled consumer spending. Plus, after April 2022, M2 growth slowed, even shrinking slightly by 2024, yet stocks didn't crash. They hit new highs in late 2024. Clearly, M2 isn't the only driver. The post says F. Benjamin Graham, but let's not dismiss the legend so fast. Graham, author of The Intelligent Investor, focused on a company's intrinsic value. Think earnings, dividends, and assets, not macroeconomic factors like M2. He'd likely argue that stock prices should reflect a company's fundamentals, not just how much money the Fed prints. Graham's approach is about long-term investing, not chasing short-term market trends driven by liquidity. While M2 can influence markets, Graham would say it's a distraction from what really matters: buying good companies at fair prices. So does M2 matter? Yes, but it's not the whole story. Inflation, interest rates, corporate earnings, and investor sentiment all play huge roles in stock prices. For example, in 2022, when M2 growth stalled, inflation soared to 9% and the Fed hiked rates. Stocks initially dropped, but by 2024 they recovered as earnings grew and inflation cooled. M2 can create a tailwind for stocks, but it's not a golden rule. The post oversimplifies a complex system, and throwing shade at Graham doesn't make it more convincing. Markets are more nuanced than money printer equals stocks go up. The money printer theory has some truth. M2 growth can boost stocks, but it's far from the only factor. Benjamin Graham's principles of value investing still hold up, even in a world of big money supply swings. So next time you see a bold claim like this, take it with a grain of salt. If you enjoyed this deep dive, hit that like button, subscribe, and let me know in the comments, what do you think drives stock prices? See you in the next video. Thank you so much for watching the FinBot Insights channel. Your support means the world to us. Be sure to like, subscribe, and leave your thoughts in the comments. See you next time.